Imagine being promised financial freedom and returns most banks could only dream of. Celsius Network loudly declared itself the safest place for your crypto, offering double-digit interest rates and assuring depositors their money was safer than in a traditional bank. Hundreds of thousands of people entrusted Celsius with their savings, inspired by the charisma of its founder, Alex Mashinsky, the public face of the company. But that fairy tale turned into a nightmare. The platform collapsed, freezing clients' funds and igniting a scandal on the same scale as the fall of FTX. Mashinsky's bold promises of financial freedom became a different kind of freedom, the freedom from your own money. Now it's time to uncover how Celsius rose on the wave of the crypto boom and why it crashed, leaving investors with nothing. A story of downfall, deception, and lessons worth millions. Celsius Network was founded in 2017 by Alex Mashinsky, together with Daniel Leon and Nuke Goldstein. The idea was simple: to provide an alternative to traditional banks for storing and growing cryptocurrency. The platform offered users the ability to deposit their Bitcoin, Ether, and other digital assets, promising generous interest on their holdings. In return, Celsius could issue loans backed by crypto collateral or invest those funds elsewhere. Mashinsky positioned Celsius as a financial revolution, urging people to unbank yourself, to abandon traditional banks in favor of the Celsius crypto ecosystem. By 2018, the company held an initial coin offering of its own token, CEL, raising around $50 million in investments. Over the next few years, Celsius attracted additional funding, expanded internationally, and built up a large user base. Riding the wave of the 2020 to 2021 crypto boom, Celsius experienced explosive growth. During the pandemic, the platform, like other crypto lenders, drew clients in with promises of easy loans and sky-high returns. Double-digit annual yields became the new normal across the industry. Mashinsky claims Celsius paid up to 17% per year on deposits, far beyond any bank's offer. These unbelievable returns sparked a massive influx of funds. By early 2022, prosecutors estimated Celsius managed an astronomical sum, roughly $25 billion in assets at its peak. According to New York Attorney General Letitia James, Mashinsky's aggressive marketing through social media, interviews, and crypto conferences helped the company accumulate around $20 billion in digital assets by early 2022. The customer base grew to 1.7 million users worldwide, from everyday investors to major crypto enthusiasts. To the public, Celsius was on top of the world. 450 employees, offices across several countries, and a reputation as a reliable lender. Mashinsky, the charismatic serial entrepreneur, became for many the white knight of the crypto industry, a man promising to free people from the chains of the banking system. Alex Mashinsky masterfully built the image of Celsius as a safe haven for cryptocurrencies. He tirelessly repeated that those who entrusted their Bitcoin to Celsius could sleep peacefully, since the company supposedly never risked customers' assets and returned up to 80% of its profits back to the community as interest. "Banks fail you. Trust Celsius," was Mashinsky's signature message. "No fees, only high returns," the platform advertised, claiming its profits came from mining, trading, and lending, while the majority of revenue went back to users. For customers, it looked perfect. No hidden charges, just a steadily growing balance on their account. Mashinsky personally reinforced this trust through his weekly live streams on YouTube. Ask Mashinsky anything. He talked directly to his audience, answered questions, and radiated confidence. That confidence was contagious. Many saw him as a visionary who genuinely cared about their financial well-being. Celsius is safer than a bank. That was his mantra. While attracting clients, Mashinsky openly claimed he would keep your digital assets safer than any bank ever could. Those words resonated deeply at a time when people's trust in traditional finance was fading. "We want to give everyone a chance to get rich through crypto," he said, and many believed him, increasing their deposits and reinvesting their earnings, often ignoring the risks. Yet, even then, skeptical voices were growing louder. Analysts and users began asking, how could Celsius consistently pay double-digit returns? Wasn't it too good to be true? Mashinsky brushed off every concern. He accused critics of spreading FUD, fear, uncertainty, and doubt. Just weeks before the collapse, he urged the community to ignore the FUD, insisting that everything at Celsius was fine. But his charisma and media presence did their job. The majority of clients kept trusting the platform until the very end. Beneath the surface, Celsius was sitting on a ticking time bomb, one made even more volatile by the explosive growth of the crypto market. In 2021, Bitcoin and other crypto assets hit record highs, and Celsius ramped up its lending and investment activities. But those generous interest rates promised to clients meant the company had to chase profits where risks were the greatest. According to later investigations, Celsius poured user funds into high-risk projects and even speculated on its own token, CEL. To maintain the illusion of success, the company's leadership, including Mashinsky, allegedly manipulated the token's price, buying it back on the open market for millions of dollars to artificially inflate its value. In a private message revealed by investigators, one top executive told Mashinsky directly, "The value of the CEL token was fake. It existed only because we were spending millions." Then came the shockwave that shook the entire industry. In May 2022, the Terra Luna ecosystem collapsed. The algorithmic stablecoin Terra USD lost its peg to the dollar, and its sister token Luna crashed to nearly zero, wiping out around $40 billion in market value. That disaster rattled the entire crypto market. A wave of panic selling hit companies across the board. The business model of crypto lenders suddenly looked fragile. As Reuters noted, after Terra's implosion and the broader market crash, it became clear that promises like those of Celsius were unsustainable. Many Celsius users began to worry. Would they still be able to withdraw their money if things got worse? Rumors about Celsius's liquidity problems started spreading online. In response, the company posted a blog in early June, dismissing critics as vocal actors spreading misinformation and denying any major losses from the Luna collapse. Mashinsky personally stepped in to calm the panic. Just days before the catastrophe, on June 10, 2022, during his regular AMA livestream, Mashinsky reassured his audience that all rumors were false. He firmly denied any issues with customer withdrawals. Celsius has billions in liquidity reserves, and we provide instant access to everyone's funds, he said calmly on air. He even went further, accusing critics of being paid by competitors to damage Celsius's reputation. For anxious investors, those words sounded reassuring. If the CEO himself says the company has billions in reserve, what could go wrong? But as it turned out, those reassurances only delayed the inevitable panic by a few short hours. It was the evening of June 12, 2022. Out of nowhere, Celsius released an emergency announcement. All withdrawals, swaps, and transfers between accounts were being immediately suspended. The reason? Extreme market conditions that required the company to stabilize operations. In other words, the platform froze its clients' accounts, cutting them off from their own savings. The news hit like a thunderclap. Just days earlier, users were assured they had full access to their funds, and now, everything was locked. According to the company, the decision was made to prevent a bank run, a mass withdrawal of funds that Celsius simply couldn't cover. The effect was instant and brutal. Bitcoin and other cryptocurrencies crashed. Within 24 hours, Bitcoin fell about 12%, and Ethereum dropped 14%. Celsius's own token, CEL, which had traded near $7 a year earlier, plunged more than 30%, down to just 21 cents. The shockwaves even reached unrelated markets. Shares of Celsius Holdings, the energy drink company, suddenly fell 10%, as confused investors mistook it for the crypto lender. But the real pain was felt by hundreds of thousands of Celsius clients who found themselves cut off from their money. According to official data, around $4.7 billion worth of crypto belonging to users became inaccessible overnight. These were life savings, from small personal accounts to multi-million-dollar holdings. Among the victims were 1.7 million customers from around the world, including over 26,000 residents of New York State. For many, it was pure shock. People couldn't pay bills, tuition, or rent. Their money was trapped inside the platform. In the days that followed, panic and rage swept through the Celsius community. On social media and online forums, depositors shared their despair. Later, when the bankruptcy case began, some wrote heartbreaking letters to the court, saying Celsius had destroyed their lives and their hopes for retirement. Mashinsky and the Celsius leadership went almost completely silent after the freeze, further eroding what little trust remained. It also emerged that shortly before the collapse, Mashinsky had quietly withdrawn around $8 million of his own funds. For users, this revelation was the final betrayal, proof, they believed, that he had saved himself just before slamming the doors on everyone else. After a month of uncertainty, on July 13, 2022, Celsius officially filed for bankruptcy under Chapter 11 of the U.S. Bankruptcy Code. By that point, it was clear. The platform was insolvent. It didn't have enough assets to cover what it owed to its clients. In court filings, Celsius admitted to a hole in its balance sheet of about $1.2 billion. That was the size of the deficit. Out of roughly $5.5 billion in total liabilities at the time of bankruptcy, about $4.7 billion belonged to customers whose deposits had effectively turned into unsecured debt. In other words, nearly all the money Celsius owed wasn't to banks or institutions. It was to ordinary people who had trusted the company with their savings. They were now unsecured creditors, waiting in line to see if they'd ever get anything back. The bankruptcy triggered a long and complex legal process that dragged on for more than a year. In September 2022, the court appointed an independent examiner, a financial expert tasked with investigating Celsius's operations to determine whether the company had been a fraudulent scheme and how such a collapse had happened. As the hearings unfolded, more disturbing details emerged about the company's inner workings. It became clear that Celsius had essentially been running on borrowed time, paying old clients using the inflow of new funds, while trying to plug the gaps through risky investments to sustain its promised yields. Some observers called Celsius a crypto bank without insurance, since, unlike traditional banking, there was no government safety net, and depositors were left with nothing. For Alex Mashinsky, it was the moment of disgrace. Under pressure from creditors and public outrage, he resigned as CEO on September 27, 2022. In his resignation letter, he expressed regret, saying he had made decisions that, in hindsight, turned out to be wrong in terms of asset deployment. He promised to cooperate in returning funds to users, but trust in him was already gone. Billions of dollars remained frozen, and thousands of families around the world faced financial devastation. According to court records, by the end of 2022, Celsius still owed about $4.3 billion to its customers. Some of the largest clients lost tens of millions. Regular people lost everything they had. Stories surfaced. A father who lost $375,000 saved over a lifetime. A veteran who lost $36,000 he'd spent nearly a decade accumulating. There were thousands of such stories, a testament to the scale of the collapse. The bankruptcy process continued through the fall of 2023. Eventually, the court approved a reorganization plan. Part of Celsius's remaining assets would be sold, and the rest would form a new Bitcoin mining company to help repay creditors. By early 2024, Celsius announced it was emerging from bankruptcy and had begun distributing roughly $3 billion in crypto and cash to affected users. Still, most depositors received only a fraction of what they had originally invested, a so-called haircut. The real losses measured in billions, may never be fully recovered. After Celsius collapsed, the company, and Alex Mashinsky himself, came under not only public but also regulatory scrutiny. U.S. authorities launched multiple investigations into possible fraud by Celsius's leadership. The first wave of accusations came early in 2023. On January 5, 2023, New York Attorney General Letitia James filed a civil lawsuit against Alex Mashinsky, accusing him of deceiving investors. The suit claimed that Mashinsky had concealed the company's true financial distress and misled people about the safety of their funds. He continued to promote Celsius as a safe alternative to banks, promising up to 17% returns while hiding hundreds of millions in losses from risky investments, the filing said. Alex Mashinsky promised to lead investors to financial freedom. Instead, he led them to financial ruin, Attorney General James declared. The lawsuit sought to ban Mashinsky from doing business in the state and to recover damages from him personally. But the real legal storm was still ahead. In the summer of 2023, exactly 1 year after Celsius's bankruptcy, U.S. authorities launched a coordinated strike. On July 13, 2023, Alex Mashinsky was arrested in New York and charged with a series of financial crimes. That same day, federal prosecutors from the Southern District of New York unsealed an indictment accusing him of securities fraud, commodities fraud, wire fraud, and conspiracy to manipulate the market. Alongside Mashinsky, former Chief Revenue Officer Ronnie Cohen-Pavone was also charged. Investigators claimed that Mashinsky deliberately misled clients about Celsius's success and profitability, concealed risks, and lied about how their deposits were being used. He and Cohen-Pavone were further accused of conspiring to artificially inflate the price of the CEL token, all while secretly selling their personal holdings at the market's peak. In essence, U.S. authorities accused the Celsius founder of running a multi-billion-dollar fraud scheme that ended in the company's collapse and massive investor losses. The same day, regulators filed their own civil actions. The Securities and Exchange Commission, SEC, charged both Celsius and Mashinsky with misleading investors and violating securities laws. The Commodity Futures Trading Commission, CFTC, filed a separate complaint, alleging that Celsius illegally operated as a commodities pool and misled customers. And the Federal Trade Commission, FTC, announced a settlement. Celsius agreed to a penalty of $4.7 billion and was permanently banned from handling customer funds. That staggering figure, $4.7 billion, was roughly equal to what Celsius owed its 1.7 million clients. However, the FTC suspended collection of the fine due to the ongoing bankruptcy process, prioritizing restitution for victims instead. Still, the sheer size of the penalty, one of the largest in FTC history, underscored the gravity of Celsius's misconduct. Following his arrest, Mashinsky initially pleaded not guilty and was released on a $40 million bond. But the evidence was overwhelming. Investigators had internal Celsius documents, private communications, and witness testimony. The case reached its climax at the end of 2024. On December 3, 2024, Alex Mashinsky struck a plea deal. He admitted guilt on 2 counts of fraud, including manipulating the CEL token's price and deceiving customers. As part of the agreement, he consented to the forfeiture of approximately $48 million in illicit gains, the profit he made selling his overvalued CEL holdings. That confession became, in many ways, a public admission of guilt before the entire crypto community he once claimed to protect. The sentence came swiftly. In early May 2025, the federal court in New York delivered its verdict. Alex Mashinsky was sentenced to 12 years in prison. Judge John Coltle, announcing the sentence, emphasized the scale of the fraud and the cynicism of Mashinsky's actions. Prosecutors stated that Mashinsky raised investments promising to keep them safer than a bank, while in reality making reckless bets and lining his own pockets. He earned tens of millions while his clients lost billions. In addition to prison, Mashinsky received 3 years of supervised release, a $50,000 fine, and the formal forfeiture of the $48 million in illegal profits. This became one of the most high-profile punishments in crypto history, a clear signal that even in the new wild world of digital finance, fraud still has consequences. The rules against deception stand firm, and those who betray investors will face the cost. The story of Celsius is a cold wake-up call for anyone who blindly believes in guaranteed returns. Hundreds of thousands of people lost their savings, lured by promises of 17% annual yields and the reassuring words, "Your money is safe." Alex Mashinsky was once hailed as a hero. Now he stands as a symbol of deception. The money was safe until it wasn't. That's the true epitaph of his empire. The red flags that should never be ignored. Promises of high profits without risk. A cult of personality built around a so-called genius founder. A lack of regulation and transparency. A native token that can be manipulated. Denying problems by labeling criticism as FUD. The golden rule remains the same. Diversify and verify. Never trust any platform with more than you can afford to lose. True financial freedom isn't about chasing quick returns. It's about understanding where your money actually goes. Let the story of Celsius serve not as a tragedy, but as a reminder. In crypto, survival belongs not to the fastest, but to the smartest.